Well, welcome everyone to the Bell Asset Management webinar, Global Equities Investment Themes for 2021. My name is James Biggins and I'm a Sales Director at Channel Capital. We are the distribution partner to Bell for Bell Asset Management. Bell Asset Management is a global equities manager based in Melbourne with two investment strategies, the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Today, I'm joined by Ned Bell, CIO of Bell Asset Management, where Ned's going to provide his perspectives on valuation of global equity markets as we look forward to 2021, the lessons learned this year in the context of previous market corrections, as well as interesting sub-themes in emerging and global small and mid-cap companies. A brief background on Ned. Ned has over 20 years of experience in the investment management industry and is primarily responsible for the overall return outcomes for client portfolios and providing investment thought leadership. Ned is also responsible for recruiting talent, organising and mentoring the investment team in the Bell way of managing assets. We kind of see at Channel a number of reasons to look at global small and mid-cap stocks for client portfolios. And a number of these reasons kind of come from the strong potential growth opportunity, diversification to client portfolios, and we also see the current market in a business cycle sweet spot. When you add the Bell Asset Management way of defining the mid-cap universe, you get a really powerful exposure to an investment solution that has delivered top quartile returns with a low risk profile. The webinar today is going to run to 1:15. We can submit questions through to us the Q&A box down below. The next slide is just an important disclaimer. Please read it. I know it's very small font, but please read it at your own discretion. And now, Ned, I'll turn to you. It's good to be in the same room with you today. We haven't done this for a while, but I thought we might begin today's session just looking at your thoughts on earnings. And earnings have taken a really big hit in 2020. Yeah. What should investors and how should investors be thinking about post-COVID earnings?
Yeah, thanks for having me, and welcome everyone to the webinar. So I think this is one of the most interesting parts of the market we think about now, is this idea that there is a very large earnings recovery to come in the next 2 to 3 years. And we did some analysis, which is on this chart here, and it basically shows, amongst other asset classes, how global small mid-cap stocks have performed in the subsequent 5-year period after the previous two big earnings troughs. So the last two big earnings troughs in global equities were post the dot-com boom and bust, which was in the early 2000s. And at that point, you saw global earnings fall by 40%, and then they recovered by 200% in the subsequent 5 years. And then post the GFC, you saw earnings fall by 46%, and that's from 07 to 09, and then recover by about 65% in the subsequent 4 years. But the point being is that what comes after that recovery is phenomenal performance in small mid-cap equities. So in both those periods, this chart shows that in an absolute sense, in USD terms, just by allocating to small mid-cap equities, you would have got a return of 221% or 231% in the subsequent 5-year period. So the idea is you buy these stocks in the trough, and that's where you can just generate a huge amount of return. And then when you think about and then when you fast forward to this year, and you've basically had earnings that are down about 30% for the MSCI World Index, but then in the small mid-cap stocks, they're actually down 51%. So they've taken a big hit. And it's this idea that there is a big hockey stick to come, and that's where investors can really make a lot of money in the next couple of years.
Yeah, great. And where do you see the most upside for those global equity investors over the next kind of 2 to 3 years? Is it in that small mid-cap space?
So, yeah, it's a good question. I think the way you need to think about it is, or the way we think about the upside from here is, again, we're obviously, the markets are at their highest. And so everyone's asking themselves the same question: where is there still good value to be found? And when we think about, I guess, the various growth cohorts within global equities, it's no secret that you've got large cap growth has been a phenomenal performer. You've had the FANG stocks do incredibly well, but they're also pretty expensive. In a way, the opposite has actually happened in small mids. Like, they've actually lagged, not because they've been fundamentally, affected that much more, but they just haven't had a lot of that passive buying that's sort of driven those stocks high. So we tend to think that the the small mid-cap sector within the overall growth halt is where there's the best possible combination of, I guess, the ability for valuation to re-rate, but also that earnings recovery. So, and if we were just to look forward on the next chart there on page 4, I think this really sort of highlights a couple of key points about why now is such a good time to be putting money into small mid-cap stocks. And the chart on the bottom left really just, it shows that, over the last 3 years, again, you've had the asset classes lag by about 3.4% per annum, but over 20 years, it's outperformed by 2.2%. So from our perspective, there's a pretty strong argument you'll get this mean reversion that will happen in the next couple of years, and the trigger will be this sharp earnings recovery. And then from a valuation perspective, you can see in the top right, we put together a chart that shows the relative value of, so that's the relative PE of global small mid-cap stocks versus large cap growth. And what you can see there is that on a relative basis, it's trading at a 10-year low. Like they're very, very inexpensive in an absolute and relative sense. And that chart on the bottom right shows that effectively this asset class has done nothing in the last couple of years. It's right back to where it was a couple of years ago, really back to around that sort of 2018 type level. But again, that's not that when you pop the hood, the reality is the earnings have still been pretty good. Stocks just haven't really kept up. So that's probably where we see probably the most opportunity, I think, at this point in the market.
Yeah, excellent. And I guess pivoting from here, we've had a lot of interest and obviously a lot of press around the US election and then the vaccine rollout on top of that in 2021. I guess what are the most important implications for investors going into 2021?
Yeah, so going into 2021, there's a multitude of factors there. Obviously, the US political transition is changing, quite dramatically. We might skip forward to the next slide also, just on page 5. But I think the way we're thinking about it is that, from a political perspective, clearly there's probably a few more adults at the table managing the US economy, completely different scenario. So I think politically the way we think about it is that the Biden administration will be a lot more, they'll be a lot more hands-on in terms of obviously trying to manage COVID. So from a short-term economic growth perspective, that probably could result in a bit more short-term pain, but for long-term gain. So net, we see that as being a big plus. But at the end of the day, what we're really keeping our eyes on is the ability of the global economy to recover. And clearly that has become inextricably linked with the management of COVID. And while the vaccine news is fantastic, it's great, it's not necessarily a silver bullet. Like, it's going to take time. There'll be logistical issues in terms of the rollout. So it's fantastic news, no doubt about that. But we still see some risks in terms of the recovery and the pace of the recovery. We tend to think that it's probably going to be more like a 2022 type recovery, and that when the Biden administration comes in, they're inheriting a pretty a problematic economy. But what we see out the other side and is that this idea that the consumer in the US, representing around 70% of GDP, that's really what drives the economy. It's really the consumer. And so clearly the consumer in many ways has been locked up because of COVID. Definitely. Cases are still pretty terrible. So that is still been a pretty big inhibitor on growth. But once it's controlled, we do feel like there's quite a lot of pent-up demand from a consumer spending perspective. They're going to spend in different ways, but nonetheless, there is this idea that the doors will fling open at some point. And that really gives us quite a bit of optimism that rebound will happen, whether it's second half next year or early the following year. So those are the main things. I think another point I'd make in terms of next year, one thing we're paying particularly close attention to is it's the shape of the earnings recovery, because one of the issues we're sort of a bit cautious on is that earnings estimates for next year in global equities are implying that basically earnings will recover to a level where they're about 14% above 2019 levels. Now, that seems to us a bit overly optimistic. So again, if we come back to the previous two earnings troughs, early 2000s GFC, the earnings, it took 2 to 3 years for the earnings to recover to pre-crisis levels. So we naturally ask ourselves, well, why would it be any different this time around? So to some degree, the markets are pricing in a very rosy outlook.
Goldilocks.
Outlook.
Yep.
And there's no question there's lots of good news, but the issue is a lot of it's been priced in like it's going to happen tomorrow when it might not quite happen tomorrow. So it's going to be an interesting. This year was an interesting year. Next year is going to be even more interesting, I think.
Well, and taking that kind of theme of next year, we've obviously had some winners and losers. You know, the stay home effect, that's probably helped the FANG stocks, which you mentioned before.
Yeah.
Assuming we get that kind of, COVID dissipates next year, and so 2021, what are the structural winners and what are the structural losers, and then playing that into 2022?
Yeah, it's a good question. I'll touch on the FANG stocks first, and then I'll dive into that question because I think this is, clearly the FANG stocks have dominated performance in the last couple of years, and collectively they're terrific companies, great franchises. We all know that. But one of the risks is that and this comes back to this idea of thinking about the growth curve, if you like. So point being is that a lot of those FANG stocks, in many ways, COVID has precipitated 2 or 3 or 4 years of earnings growth pulled forward into 1 or 2 years. So the steepness of the earnings growth curve this year has probably been quite steep. And so if you take Facebook, Apple, Amazon, Alphabet, Netflix, and Microsoft, those names have, on average, they've grown their earnings by 26% this year on 19. And they're trading 44 times earnings. The trick then becomes, or the issue then becomes, when that growth starts to moderate a little, like consensus has got that growth going from 26% to about 21% next year. That's where there can be a little bit of risk. Now, when you think about the, coming back to sort of the land of small mid-cap stocks, it's pretty much the opposite as the case. It's like you've actually had, in the types of stocks we invest in, they've effectively had flat earnings. And in many ways, the earnings have just been pushed out into next year. So you've got this, completely different sort of shape of the growth curve, which is still to play out. And that's a really different, way of thinking about getting growth exposure. Is sort of that idea that FANG stocks couldn't have been better. Yep. They're priced like it couldn't be better. But then this idea that you can rotate into smalls and mids where the benefit is yet to come is still there. So I think, so that's one point on the FANGs and how to think about them relative to the small mid-cap type growth names. But as far as the actual themes and the thematics that have been, I guess, brought out by COVID, and you talked about some of the stay-at-home themes, and if we just turn to the next page, we've got a list of like some of the stocks that we've got exposure to and some of the thematics that have been driving them. But clearly there have been some companies that have done really, really well. And so if you think about these companies on this page, they've all got varying degrees of, I guess, benefit that have come from, I guess, COVID themes. And this year they've actually, on average, they've grown their revenue by 7%, grown their earnings by about 11% against the backdrop of earnings, basically just being totally cratering. The question then becomes, that investors are asking themselves is, okay, but isn't it just a one-off and it's never going to happen again? And the way we think about it is that's not necessarily the case. So if you think about particularly the consumer sector, like the discretionary stocks, the staple stocks, and like we've got a couple of names that are probably benefiting from the whole work from home thing. In staples, boring old companies like Kroger, which is like a supermarket company, Church and Dwight, doing well. But work from home is not going to go away completely. People will go back to the office, but in some way, shape or form, work from home is with us for a long time. And then in terms of in the discretionary stocks, two thematics being home improvement and also these localized leisure activities where they're staying at home and they're doing up their pools and they're tinkering with their cars. Their vacations are more about camping and that sort of thing. Is that going to just completely change back to traveling overseas next year? No, not going to. The reality is no one's traveling overseas for quite a long period of time. So we would argue that there is quite a bit of longevity to these themes. that are still to play out. And then in terms of the healthcare sector, I think that's where it's like we've got some companies that have probably benefited marginally, but the idea is that a lot of the, for example, in the dental space, a lot of the procedures that probably would have happened this year have been pushed out into next year. So they haven't gone; they've just been pushed out into next year. So, and then obviously in the IT space, you've got companies like Arista and Broadridge, which are also benefiting somewhat. So, so we do think there's longevity there, and if anything, it's probably strengthened the tailwind.
Yep. And so with that kind of change, you'll start to, as you see those trends come through, start to upweight those names. Is that kind of the thought around the portfolio construction piece?
Yeah, I think that's right, and particularly in the consumer space. I mean, we're particularly looking at the sectors and the opportunities where they're not that those benefits I was talking about aren't necessarily priced in.
Yep.
So if you think about what's happened just recently, there's been this mad rush into the most cyclical stocks you can find. So it's energy, regional banks in the US, just flying off the charts, like everything's just going to return to, Goldilocks.
Yep.
We look at that from a slightly different perspective and think, you know what, you want to be betting on the consumer getting out of the house and spending more money, and there's pent up demand. So we think that there's a lot more earnings upgrades to come in that consumer sector in particular. And then again, in the healthcare space, I think that's another part of the market that is not, it's viewed from a top-down perspective as being, very non-cyclical and therefore not a great play, if you like, on a global economic recovery. But the reality is that the dynamic in healthcare has changed quite a lot, because to my earlier point, a lot of the procedures that were delayed have just been pushed out. They're not going away. But the other reality is from my perspective, the relationship between governments and healthcare companies has changed quite a bit. It's gone from being in normal presidential elections, the healthcare companies become the piñata for every candidate, and it's all about cutting prices and etc. Now, complete COVID world, complete opposite, where all of us they're embracing them and saying, "Please help us out of this mess."
Yes.
That is very different. That removes, or at least reduces, a very big political overhang that has been there forever, and that doesn't mean the growth rates go from 10% to 30%, but it means that there's less pricing pressure, and that the companies, I think, there's probably more large cap pharma comment, but they can hopefully start to get more of a return on their investment going forward, which is a little bit different to how it's been the last couple of years.
Yeah, great.
Yeah.
And then I guess, again, changing tack now to kind of finding value for money at market highs, and you mentioned this before, that markets are priced for that Goldilocks kind of scenario. So given where we're trading at the moment in terms of all-time highs, is there still value to be found in that global small mid-cap space? And sure. I guess you've highlighted on a couple of those themes, but it'd be good to kind of just get your thoughts about where we are. Sure.
Yeah, so the answer is yes, there's still good value for money to be found. And so when we think about the asset class itself is trading on about 21 times earnings. So the earnings yield is effectively around 5%. So that's like extraordinarily low interest rate environment. That's a relatively good absolute valuation, we think, particularly for something that's got that earnings hockey stick yet to come. But then when you get down to the actual stocks themselves, and I'll just touch on our portfolio just to bring it into context, but we still find really good value. I mean, I was looking at it before, we've still got, I think 13 of our names that trading on free cash flow yields above 5%. I mean, and this is for a portfolio or an average PE of, around 20, 21 times. But, for that, you're actually getting a portfolio that of companies that have been able to grow their earnings by 22% per annum over the last 5 years, grow their revenue at 15% per annum in the last 5 years. They're not going to do that this year. But the idea is that this is again, the way to think about global small mids or the way we do it is this idea that it does play a growth role. So it should be looked at as being an alternative to large cap growth or EM or even Aussie equities. But on a value for money basis, we're still finding good things to buy, which is not the case if we were just living in the world of large cap growth. It'd be a lot harder. So we are, and I think if we can just turn to the next page, this really sort of highlights, I think, sort of some of the types of names that we invest in, and again, a lot of these companies, I mean, they're not ridiculously expensive. They trade at reasonable valuations. The multiple expansion hasn't been nearly as big as what it's been in large cap growth. But they tend to be businesses where we can still see pretty good case for multiple expansion going forward.
Excellent. And I see on the top of the slide, we've got the word quality, and I mentioned it in my opening statement.
Yeah.
As a global quality investor that can invest across the market cap spectrum, what can investors get exposure to that can't be found within that large cap space? And you've highlighted a couple of things, but it'd be good to kind of explore that a little bit more.
Yeah. So, I mean, I'd say a couple of things. So first of all, you get exposure to companies that they're fantastic niche businesses. Like they've got the size of the TAM, or the total addressable markets. It's often not as big, but they've got really interesting franchises and they own them, and the earnings are very much driven by those franchises. So you look at a company like Mettler Toledo, which is in precision weighing instruments. I mean, it's not very thematic, but they're really good at what they do.
Yeah.
And they own it, and they crank out a 30% return on capital almost every year. So same thing with Pool Corp, which is, again, they're a COVID beneficiary, but they're also so the biggest pool company in the US. A lot of what they're doing is consumables, and to do with also pool renovations, that sort of thing. Like Yeti, fantastic up and coming consumer brand. I sort of liken it a bit to Lululemon 5 or 10 years ago, where it's this tiny little brand that was founded by two brothers in Texas, in the outdoor space, but just got such a long runway of growth ahead of it. So you find these fantastic businesses that, and the way we think about it and we apply our quality sort of, approach to it is that we're not investing in these upstart companies. These companies have been around. They've got franchises. They're generating free cash. They've got great return on capital, but they've still got the runway ahead of them, and that's the sweet spot. And then, I mean, the other points I'd make is that in terms of what do you find here that you don't find in large cap is you effectively find it's like a different flavour of growth in a way. Like I was looking at for example, our healthcare stocks. They're growing their earnings at 15% per annum. So, and to someone who lives in the world of large cap stocks, those sorts of growth numbers just don't add up with healthcare. They just don't.
Yeah.
So the way we think about it is that, and it comes back to the earlier point about the role this type of strategy could play in a broader portfolio, is that it's uncorrelated type growth. So having healthcare growth or growth coming from a series of smaller sort of consumer themes tends to complement that very heavily weighted towards large cap sectors. So there's a number of themes there we think that still play out. And
you've highlighted a couple of companies through here, but what is kind of one of the more interesting? I know Yeti. I've got a couple of their products, but it'd be good to kind of explore a couple of the names that are on here and get a bit of a sense of something that people probably don't know too much about.
Yeah, sure. So. So I've mentioned a few of them. I mean, some other ones, if you're into lawnmowers, Toro's your lawnmower company. So they in the US, they kind of own that industrial lawnmower market, and this is much more for, I guess, sort of like sports fields, and this is where local governments are buying this sort of equipment. So again, it's a weird market, but they own it. They generate great returns on it. Amber is another really interesting one that my colleague Joel and I came across 5-6 years ago when we were in Copenhagen. So they make, amongst other things, they make these disposable endoscopes that surgeons use to look down the throat of a patient, and they're basically taking market share away from these reusable scopes that obviously cause infection. And so you think about in a COVID world, clearly infection is a huge issue. So they're getting a nice little incremental kick there. Hershey's for the chocolate lovers, still phenomenal brand there. TTI up there, you can see, which is Tektronix Industries. So it's a Hong Kong listed company, but they're the company behind Ryobi and also Milwaukee Tools. So, and that's an interesting company in that they're benefiting not only from, I guess, the whole stay at home theme in the US, but also the fact that a lot of their products moving from moving towards like cordless power drills and cordless equipment is, they're the cutting edge of that. So they've all got these quite interesting little themes there that in isolation are sort of, they're quite interesting. And then again, the TAMs are not necessarily massive, but they tend to own the market. They have basically very consistent earnings growth, and return on capital is extremely consistent. So, and then, a few other ones would be companies like Partners Group, which a lot of people would be familiar with in the alternative space. And so, yeah, look, there are terrific companies there, and but it does require you've got to wear out some shoe leather to find them, because they're not that easy to find, and there's a lot of duds out there too. So you need to really do the work.
Well, and exploring that a little bit further, wearing out the shoe leather. We're here. We're finally sitting across from the table from overseas, as you were saying before.
Yeah.
How have you found, getting access to companies, and how have you found, trying to find the gems out there when you're doing work? Has it been easier or harder, or?
It's been easier than what we thought.
Yep.
Is the way I'd say. So because we've been investing in this space for 18 years, thankfully, a lot of the shoe leather's been worn out in the previous 18 years. And so we've built up sort of pretty well orchestrated theses and like playbooks, if you like, on a lot of these companies. So there's about 150 companies that we would classify as small mid cap that pass our quality test, if you like, and they don't change that much. So that puts us in a position whereby a lot of the work we're doing is updating and tweaking our theses. To your point, if you're trying to relearn a company from scratch in this environment, it is harder. That's where you can miss something. But if you've already built up, again, a playbook on 150 odd companies, and you know them pretty well, you can have a lot more confidence in making those calls. But I think the other thing is that our engagement with the companies really hasn't missed a beat. If anything, it's probably gone up, because, first of all, we're saving a lot of time by not being on planes. Secondarily, the companies themselves are saving a lot of time because they're not going across the US from conference to conference. They're in their offices, and you can arrange Zoom calls, at relatively short notice. So it's actually been sort of quite good in a way. And then I think we're all looking forward to things eventually recovering, but it really hasn't. It hasn't been a big inhibitor. If anything, I'd say if anything, it's probably leveled the playing field. Probably a lot of investors in the US and Europe now know what it's like to manage global equities out of Australia.
Exactly. Exactly. It's a good point. Now, we are open for Q&A, and there's a couple coming through, so thank you. I guess the first one from Dominic is that, Ned, can you kind of define the mid cap space versus mega and large cap? Just the way that Bell go about it.
Sure. So what we do is we start with MSCI. They define small mid as being the bottom 28% of each country, each developed country. One of the problems with that is that the cutoff for each country is different. So we apply that 28% threshold to the MSCI World Index, which means that our market cap range at the moment is between it's actually about 34 billion US now. So, and then in terms of our portfolio, the average market cap of our portfolio is around 14 billion US versus about 9.5 billion for the benchmark. So we do have a slightly different approach in that we can capture more of those mid-cap stocks in the way we define it, which we think is far more logical and frankly far more scalable way of managing this asset class, because that's where, and for example, right now we've got a bias towards mid-cap names because that's where we're seeing, like, frankly, the best value and the best opportunities to make money. A lot of the small-cap growth stocks have, they've run really, really hard, and many of them are more expensive than their large-cap peers. So having that flexibility to oscillate between them is a massive advantage. And so we'd have, and just to add a bit more context around the definition, we would have 700 names globally would pass our initial filter, which is 3 years of return on equity above 15%. So it's pretty deep. It's a pretty deep bench. And again, we just don't see why you would restrict yourself to the 500 mil to 5 bill range. I mean, there's terrific companies there, but you're just missing out on everything between 5 and say 34 bill. And then to put that into context in terms of the large cap end of the market, I think the last time I looked, I think the weighted average market cap of the MSL World Index is about 300 billion. So it's there's a huge gap.
Yeah,
there's a massive gap. But again, the way we think about it is that if you isolate that bottom 28%, there is so much opportunity there, and it's just we just find. I mean, we feel sport for choice, which is it's a great way to be at this point in the market.
Yeah, excellent. And another question's come from Angela, just on your thoughts and process around ESG and how you kind of incorporate that into the portfolio.
Sure. So ESG has been incorporated in the way that we manage money since inception. And it's obviously evolved as we've gone, but there's a couple of key points. First of all, we screen out various sectors, like we screen out things like tobacco, cluster munitions, coal, uranium, adult entertainment. They get screened out. Our quality test, one of the 6 factors is ESG. So we take a judgmental view on ESG issues. And what we try to do is really get to the bottom of what are the most relevant ESG issues for that company in particular. And they're very different depending on the company. But what's the company actually doing about it? What are they doing about it? So if you take Hershey, for example, it's child labour. I mean, that's the issue. It's like it's sourcing cocoa. Same thing with a company like Givaudan. It's child labour. That's the issue. So we engage directly with the company. We try to understand what are they doing about it. Are they trying to actively mitigate that risk or not? And it tends to be pretty black and white. And what sort of steers us away is when companies tend not to really acknowledge that risk or acknowledge the need to be proactive about it. Another one would be Moncler, which is the Italian luxury company, big manufacturer of down jackets. So clearly the sourcing of that down is a very sensitive issue. And to their credit, they went above and beyond, and this is probably about 4 years ago from memory, but they went to PwC. They got them to do an independent report on how they go about sourcing that down and how sustainable they're being. And so putting themselves on the chopping block to be, examined in the public eye was to us, that was pretty, that's a good sign that the company takes it very seriously. And they're not trying to just tick boxes, like they really get to the bottom of it. So we do feel that there is a very close correlation between, particularly in the small mid-cap space, between great ESG companies and great performance. And you've seen that, in the last couple of years where you've actually seen, particularly European companies, they are really they're the leaders in this space. And the companies, they just do a terrific job. And I think the other thing is that we actively encourage the companies themselves to engage, to be more open. And we're seeing that in the US more. And like, for example, with Yeti, we had a chat with them. I mean, we've owned them for a while, but we had a discussion with them about 6 months ago where we were making this point. You've got to engage more with MSCI because all the things that you're doing are actually quite good, but you're just not communicating as well. And they did that. And the net result was their first share rating was a AA.
Great.
Which is fantastic. So we try to really, work with them and help them, because often it's just telling the message. It's just getting the message across to whether it's MSCI or Sustainalytics, but it is a really important part of what we do.
Yeah, excellent. And a question here from Robert, which I think is an interesting one, which is, what's the overlap between the global fund and the emerging companies fund? And if you could just kind of shed some light on that.
Sure. So the way to think about it is all of our mid-cap stocks that are in the Bell Global Emerging Companies Fund, all of them are in the Bell Global Equities Fund.
Okay.
So it's effectively a subset is the way to think about it. So 100% overlap. And at the moment, we have around 39% of the Bell Global Equities Fund are in small mid-cap stocks. So again, that's a pretty decent overweight, and more sort of backs up our view that we're very positive about it.
Okay. And another question that's come through is just the, I guess, the permanent debate around value and growth stocks. And we've seen, obviously, value have a bit of a bounce. Do you think that is sustainable longer term, or is it a bit of just people getting excited about the vaccine and that good news going to be shortly lived?
Yeah, it's a good question. It's very relevant. I'd start by saying I don't think investors should have all their portfolio on either end of the seesaw, which a lot of people seem to. But that's right. I mean, growth has been the only game in town for a number of years. Value has really suffered for a number of years. We've seen a little pickup, as you mentioned. But I think the way we think about it going into 2021 is that on the growth end of the seesaw, if you like, the valuation risk is still there. Those FANG stocks, they're still trading on 44 times earnings. Now, I mean, that argument hasn't got in the way of them outperforming recently, but the risk is still there. And then on the value end, we can absolutely see the idea that the earnings of those stocks will recover. Having said that, there is one issue that is not talked about as much, which is the idea that a lot of companies that reside, if you like, in the value cohort are companies that have been where COVID has, like there have been companies in secular decline, like the department stores, like Macy's, those types of companies where COVID has actually just put the nail in the coffin, where there have been companies in secular decline for a long period of time. They look cheap, but then they go bankrupt. If you think about the cruise line industry, I mean, does anyone realistically think you're going to get 3,090-year-olds onto one of those ships anytime soon? I mean, it's not going to happen. They might recover a little bit, but a lot of these businesses are structurally impaired for a long period of time. So I don't think, and I think that part of it is missed. That's not talked about quite as much. And the other sort of concern I kind of have around the premise that value will just bounce because the jaws need to close is that the earnings estimates for those value stocks are very high. So again, from memory, the expectations for the MSCI World Value Index has earnings next year being about 10% above where they were last year in 2019. Right. Now, in the last 20 years, that hasn't happened. You've not seen an earnings recovery like that. And for that to happen, it has to come with effectively a coordinated global economic recovery, which we all hope is going to happen, but it's not banked. It's not necessarily going to happen. So I think but again, the idea is that there's risk at both ends. Value could continue to do well. I mean, it absolutely could. But by the same token, I think there's other parts of the market which aren't on either end. So if you think sectors like healthcare and staples, their relative valuations are both around 20% below their 5-year averages. So there's a pretty compelling relative argument there, but they're not traditional value stocks.
Yep. Well, I think you look at the screen as well, you've got a good mix of companies that sit across different buckets as well. So it's not just, and that's what you want to get out of a portfolio construction. Exactly right. Okay. Well, in the interest of time, we do, there's no more questions that have been raised. So I'd like just to say, Ned, thank you very much for your time today. It's been good to actually be physically see for once rather than over Zoom. And everyone else, thank you so much for joining the call. If there are any further questions, please reach out to Channel Capital. There will be a recording of this made available and the presentation deck as well provided. We thank you all for your time and look forward to seeing you all again in 2021. Thank you.
Thank you.